I think it's really possible for us to fret about the wrong details as a way of procrastinating from the hard stuff, right? So the hard stuff here, the most important thing here is fund the thing, fund your retirement, and then worry about the nuance of which type of account you're using once you actually are doing the work of setting aside that money to go into it. Welcome to the Sunlight Podcast. In this show, we're talking about taxes, money, and careers for creative people who have a big vision for changing the world with their work. I'm your host, Hannah Cole, artist, tax pro, and the founder of Sunlight Tax. If you're an artist, designer, or creative entrepreneur who wants to grow your business sustainably, manage your taxes, and build a stash of fuck you money so you can control your own time and have a bigger impact with your work, you are in the right place. Welcome, everybody. I have a controversial opinion to share with you today. A lot of you ask me what the difference is between a Roth versus a traditional IRA. And I'm here to tell you, guess what? It doesn't matter. Yeah, there is some nuance in there and we'll get into all of it. But I'm here to tell you the most important thing. If you are not fully funding your IRA, I don't care if it's Roth or traditional. If you're not fully funding it every year, then this question is moot. The first and most important thing you need to worry about is getting that money in there. If you can't get all the money, your full $6,000 limit in there every single year, I don't even want you to be worried about this question. All right. So fund it first, then fuss. All right. This falls into the category of Tiny Detail Exaggeration Syndrome. I think it's really possible for us to fret about the wrong details as a way of procrastinating from the hard stuff, right? So the hard stuff here, the most important thing here is fund the thing, fund your retirement, and then worry about the nuance of which type of account you're using once you actually are doing the work of setting aside that money to go into it. Okay, let's get into the details. So Roth versus traditional IRA. First of all, what is an IRA? An IRA it stands for an individual retirement arrangement. The individual here means that it happens outside of your workplace. That's kind of important. So you don't have a workplace-based IRA. This is really important when you are freelance because, of course, an IRA is an option, most especially for freelancers. Now, that actually doesn't mean you're ineligible for them if you have a workplace 401k or 403b. You actually can fund both a 401k and an IRA, but the IRA is kind of like icing on the cake if you have a workplace plan that you're covered by. What's really important to know is workplace plan should always be your priority. If you happen to be lucky enough to work at a place with a retirement plan like a 401k or 403b, you need to fund that one first. There's some really good reasons why. And that is one, the deadline is different and earlier. So your deadline for your workplace plan is December 31st. So your money needs to be in there by December 31st. Unlike an IRA that has a tax deadline, a tax date deadline, right? So April 15th is your IRA deadline. And the cool thing about an IRA is that you can put money into your IRA up to the tax deadline, so April 15th usually, and it can count towards the prior year, right? So it counts for the year whose taxes you're doing at that moment. Now, a lot of people will make this mistake. They get that date in their head, April 15th, and they think, oh, great, I'll put in my money to the 401k. And once it's April, you've missed your deadline, right? You can put money for the next year, sure, but you've missed your deadline for the year that's already passed. So workplace plans should be your priority because of the deadline. Second reason the workplace plan should be your priority, if you're lucky enough to have one, is that the IRS has limits about when you're allowed to contribute to an IRA. So leaning on the idea of, I won't bother with my workplace 401k, I'll just put money in an IRA, that's not always a safe bet because if you are covered by a workplace plan, even if you don't use it, you can actually get into an income bracket where you are no longer eligible to fund an IRA. Now, there are different limits for these. Roth has a higher income limit than the traditional IRA because of tax benefits you get. But this is a reason. It's just a second reason that you should always prioritize your workplace plan first. Fully fund that first before you get to the IRAs. Okay. Now, because who I'm talking to generally is somebody who is self-employed, you probably don't have a workplace plan, right? So what about us? What are we supposed to do? Now, I do have a program called Money Bootcamp, and I teach all the different kinds of retirement plans that are available for people who work for themselves, sole proprietors. But today, let's just focus on the two simplest ones, the ones you're probably the most familiar with, which are the Roth and the traditional IRA. The 2022 limit of money that you can put into a Roth or traditional IRA, either one, is $6,000. So that's first thing to know. What is the difference between the two of them? Basically, both the Roth and the traditional IRA they're both awesome. Okay. But the way that they work is they form a tax shelter. And this is a legal kind. Now, I know a lot of times when you hear the word tax shelter, you're like, it conjures like skeezy, like offshore companies and, shell corporations, things like that. This is a legal tax shelter, right? This is deliberately given to you by the US government because you funding your retirement is actually a social good. It is a good, not just for you, the individual, though it is, it's also a societal good because it means we, the rest of the taxpayers, don't have to fund you when you didn't fund yourself, right? So it is important. We don't want to see elderly people out on the street. We want you to be able to actually meet your own needs and rest and get healthcare. So it's a societal good. And because of that, there is a tax sheltered account set up to help you be motivated and save extra amounts of money by using it. Okay, so what's the tax benefit? What is it? Well, there's two different kinds. There's a front-end benefit and a back-end benefit. And the Roth and the traditional represent those two different types. So here's how it works. Let's talk about the traditional IRA first. The traditional IRA, or actually, let me just back it up for just a second. Let's talk about what a non-tax sheltered investment account would look like. Okay, let's talk about that and what the tax would be on that kind of account. Because when you understand that, then it's much easier to understand what benefit you're getting in the traditional or Roth IRA. So let's just say that I want to open an investment account, right? And I just go to a brokerage, say Fidelity, and I open up an account. And I'm going to, invest in some index funds, like a basic portfolio. This is important. Investing is actually necessary to grow your money in the way that you want to in order to be able to retire, in order to be able to put away less than a massive quantity of money. So I know that investing can be intimidating for some of us, especially if you're coming to this without a financial education, which, oh my God, I did. I did not have any financial education when I was starting out as an artist. And I've, of course, gotten one over time. And of course, now I run a company doing this. But so I know that investing is a little scary and intimidating, but it is a necessary part of saving for retirement because you do actually have to invest the money that you put into these accounts. That's really important. Every once in a while, I see a person in my tax practice who is putting money into these accounts and then not investing it. And that money isn't really growing. It's just sitting there. And of course, in the days of inflation, it's losing money. So it's actually shrinking. So investing, important. My program, Money Bootcamp, I do teach a whole really gorgeous module on investing, a really, really simple, straightforward, how to get started plan. So I just want you to be aware that the support is there if you want it. So a brokerage account, here's how it works. If I'm just going to open a regular non-tax sheltered brokerage investment account, I will call up Fidelity. I will open the account and I'm going to take money that I have earned for the year, right? And that income that I earn is taxed every year, right? We have an income tax system in our country. So that money is already taxed or it's subject to tax. I'm going to pay income tax on the money that I put into my brokerage account. That's the normal way these things work. So I put money in that has been taxed, that is subject to income tax. And then it's in the investment account. It grows in there. And then when I decide I'm ready to take the money out of the account, hopefully many, many years down the line, but could be whenever, I'm going to pay tax on that money when I take it out as well. I will pay on the gains that that money has made. Okay. So that is the normal order of things in a brokerage account. Here's how the Roth and traditional IRA change the equation for that. Let's say I want to do a traditional IRA. I'm going to put in my annual maximum, which for 2022 is $6,000. So let's say I put $6,000 into a traditional IRA. Well, the tax sheltering effect of a traditional IRA is a front end effect. So what's going to happen is the money going in at the front end is not taxed. So what does that look like? Well, remember in my regular brokerage account, the money going in had been subject to income tax. So I had paid income tax on it. In a traditional IRA, you're not paying tax. That money that you put in is actually not subject to income tax. So let's say I put $6,000 in. What does that do? Well, if I made $50,000 of income for the year, and I put $6,000 into a traditional IRA, my taxable income that I'm going to report on this year's tax return is going to be $44,000. In other words, by putting $6,000 into a traditional IRA, I am lowering my taxable income by $6,000 for the year. I'm taking that $6,000 off the table for taxation. Pretty cool, right? That is the tax benefit. So whatever tax would have been on that $6,000, I'm going to save that amount of money. For a lot of my clients, I will see like a $1,000 to $2,000 savings generally, but $1,000 to $2,000 of savings on $6,000 is pretty incredible. It actually will often boost the amount of money that you can put into that IRA itself. Because it happens at tax time, it often will result in a bigger refund, which then you can use to put into that brokerage account. It's pretty cool. Okay. The other end of the IRA, the traditional IRA, is that when I do take the money out, it will be subject to ordinary income tax on the gains of that money. Okay. So remember, a brokerage account that has no tax sheltered effect, I pay taxes on the money going in and I pay taxes on the money coming out. Traditional IRA, I don't pay any tax on the money going in, but I do pay tax on the money when it comes out. So it's tax sheltered on one end. And for the traditional IRA, it's the front end. Now the Roth IRA is basically the reverse. So in a Roth IRA, you also get a tax sheltered effect, except it's on the back end, not the front end. So now if I put $6,000 into a Roth IRA, it is not going to lower my income this year. And I will not see any tax benefit this year. But when I take the money out, hopefully many years down the line, it will not be subject to tax at that point. So my gains will be tax-free. This is pretty cool. And some financial advisors think this is the better option. Susie Orman, if you've heard of her, she thinks that a Roth IRA is always the best option for everybody. And I disagree with her, to be honest. But the reason I would say that she, is right, or the reason that she thinks that, I think, is because you are saving tax on an unknown future tax rate when you use a Roth IRA. So in a world where you believe that tax rates in the US are unsustainably low, as many of us do, then you are expecting eventually for the tax rates to go up. And therefore, a Roth is going to give you a great savings, because in a world where tax rates probably will go up, you are probably going to save even more money with a Roth IRA. Now, of course, we are talking about predicting the future. Nobody has a crystal ball. So can we actually know this? No, we can't. I think the other reason that a lot of personal finance people, including Susie Orman, think that you should always fund a Roth IRA instead of a traditional is because of that unknown future tax benefit. And that also, I think a lot of financial planners just operate as though all of us are perfect economic beings doing the right thing all the time with our money. And the fact is, that's probably not true. Right? A lot of us mess up. We make mistakes. We have years where we really need a lot of grace with our money. So what I see is that sure, a Roth might be the ideal account to use every year if you can swing it, but you don't get any current year tax benefit when you use a Roth. So it's a great option if your financial ducks are all in a row and you don't need the help this year. But the fact is, when I am doing the taxes of creative people, a lot of times people are facing, especially if you are self-employed and that self-employment tax is kicking in and you're realizing your tax bill is a lot higher than you thought it was. Well, you know what? I think a person in this position often really needs some extra help. And for that reason, a traditional IRA in a year where your tax bill is higher than you thought it was going to be, a traditional IRA is a really great option. Because it gives you a tax break this year. And sometimes you just really need the help. So the other thing I want to just point out about a Roth and traditional IRA is there are some limitations on when you withdraw it. So a normal distribution from a Roth or traditional IRA account are any distributions that are made after you are age 59 and a half. So these accounts are designed by the government to be for retirement funding, which is why you are not supposed to be pulling money out in your 30s and your 40s, right? There are some emergency provisions where you are allowed to touch the money without a penalty. First-time homeowner status is one of those instances. There are a couple more. But basically, you're supposed to wait until you're 59 and a half to touch the money on purpose because it's meant to be for your retirement. The government does not just give you a tax shelter because it feels like it. It's giving it to you for a purpose. That purpose is retirement. Okay. When you are 72, you have to have withdrawals. So the minimum age you can take money out of your IRA is age 59 and a half. But once you are age 72, you must withdraw money. And we have what is called an RMD, or required minimum distribution. These are required to be taken out of your traditional IRA once you're age 72. However, RMDs are not required of Roth accounts. They are only required of traditional IRAs. So those are some of the details around traditional versus Roth IRAs. So the thing is that's pretty interesting. Roth and traditional IRAs, they're pretty flexible. So actually, you aren't locked in. The thing about this choice is it doesn't have to be that fraught, right? You don't have to actually, I think people stress about this more than they need to. The fact is, just pick one and fund it, right? I'm so much more interested in the question of, are you putting in the maximum than I am in the question of which is the better one to pick. Honestly, they're both good. They both have a benefit, right? So you can really think it through and maximize the particular benefit that you get. And that's great, but don't stress about it. Max it out. That's the key. So the cool thing is you are allowed to alternate back and forth year to year. So you actually can fund a Roth IRA this year and a traditional next year. And then you can be like, you can just basically make a game time decision every single year about which one is better for you in that particular tax year. So if you have a higher than expected income, maybe you got a grant this year, maybe you booked a really big client and they paid you in advance, whatever it is, if you had higher than expected income and you're kind of struggling on the tax bill, a traditional IRA is a great choice for that scenario because a traditional IRA is going to lower your tax bill. Yes, you need to have the cash on hand to put into the IRA. So that is the limiting factor. If you don't have cash flow, you're going to not be able to make this work. But if you have that cash somewhere, you can put it in, it will lower your tax bill, and that can be very helpful. If this is a lower income year, but you have the cash to be able to fund a Roth IRA, then it's a great year for a Roth because when you are in a lower tax bracket, you are going to pay your tax on money that's going into a Roth, but it's a pretty low tax rate, right? So a low tax rate year is a great year to fund a Roth IRA because that is the only tax you're ever going to pay on a Roth IRA. Remember, when you take it out, it's not taxed. So it's really wonderful when you have a low income year, but you do have some cash flow. It's really nice to fund a Roth IRA. Okay. that flexibility is really helpful for freelancers. We often have really lumpy income. You get a lot of income one year, you have a low income year the next year. So it can be really nice tool for cash flow management to actually have both Roth and IRA accounts and traditional IRA accounts and toggle back and forth according to your needs. And of course, as you gain practice and confidence over time, you start developing a bit of a rhythm and a habit of fully funding your IRA every year. That's the magic. That's where you start really ensuring your long-term financial health. And, as a last word, I just want to remind you that when you invest your money, which is inside these accounts, I'm personally a fan of low-cost income funds. This is not financial advice. Oh my goodness. But, just do some basic, simple, low-key investing. The cool thing is that your money is growing. It's working for you inside those accounts. And I think that's a principle that's really important to understand. You want to have your money working and not just your body working. That is the power of investing and good financial management. It is so that you get to take advantage of some of those things that capitalism has to offer, which is your capital working instead of your physical body. So what I want you to do, if you are feeling like you really need to talk through the details of your specific situation, you're not sure about Roth versus IRA, you're wondering about the income threshold limits, spouses, how these other factors might affect you, you can book a call with me. So if you just go to my website, sunlighttax.com, you scroll to the bottom of the front page, there is a booking bar at the bottom there, and you can just hit the button and book time with me. I do 30-minute consults, and that's usually enough time to get through everything you need to, talking about your retirement plan options as a freelancer. So feel free to book that. And just to let you know, in my program, Money Bootcamp, I teach all about different retirement accounts, including ones beyond just the traditional and Roth IRA. And I also teach a module that I'm very proud of about how to get started investing, even if you have no financial education. So if you book a consulting call with me, and then you decide within the month to join my program, Money Bootcamp, there is a coupon that I give you to basically make that consulting call free, to basically reimburse you for the cost of the call. So if you do decide to join bootcamp after you do a call with me, then you've gotten that call for free. So, all right, I hope that this has been really helpful information for you. I want to remind you, don't sweat the small stuff. The big deal here is not whether you pick a Roth or a traditional IRA. The bigger deal is funding it. So just make sure you get into the habit of setting aside the full $6,000 per year if you can swing it. And if you can't swing it yet, get as close as you can to that and keep revisiting that goal so that as you gain more income in your life, you can maximize that contribution every year. All right. I hope this has been helpful for you all. Thanks so much for joining me. Bye-bye. Thank you for listening. If you like the show, be sure to subscribe, leave a review. It really helps, and share it with a friend. I'm so grateful. This podcast is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links we reference at sunlighttax.com/podcast.